All right, so in this reading, we are going to talk about the different features of companies or the corporate issuers. So, first of all, when we talk about different companies or when we talk about different business structures, we generally discuss these five factors or these 5 points. For example, when analyzing a business or when looking at the business or structure of the business, first of all, we see what is the legal status of the business versus the owners. Is the business and owners are separate? That is a 1 point. So, what is the legal status of the owners and the business? Is the business separate or not? The second point that we see is that who operate the business. Is it being operated by manager, or is it being operated by owners of the businesses? If the owners are separate, managers or board of directors are separate, then what is the relation between the board of directors and the owners of the businesses? Then the third point, the most important point, is what is the liability status? Is the liability limited or it is unlimited? And then the fourth point is what is the tax treatment, how the profits and losses from the businesses are being treated from the tax point of view. And the last point is the access to capital. As in the business structure, do you how much access or how much capital you can raise, how many sources of finance or how many avenues of raising capital are available for your business. So let's talk about different business structure. First business structure is we have the sole trader, the smallest, very simplest business structure. So when I talk about first factor, when I apply the first factor on the sole proprietorship business, is the legal status. The sole proprietorship business is not legally separate from the owners, it's just the extension of the owner. Okay. The second point is who operate the business. It is operated by owners, and or you obviously it is operated by owner. It's not the owners because it is a sole owner, sole proprietorship. Then the liability status is unlimited, means all the dues, all the liabilities, all the debt of this sole proprietorship is the owner is solely responsible, is fully responsible. If the business is not generating sufficient cash flows to cover the liabilities or to satisfy the debt on the business, because we have decided in first point that business is not legally separate, so the liability of owner is unlimited. Remember this point. And what is the tax treatment? When we talk about tax treatment, the profit of this sole proprietorship is considered as personal income. So when we have labeled the profit as personal income of the owner, so personal income tax rates and slab rates will be applied. And the last point is access to capital. So because the sole proprietorship business is in a small scale business, very small business compared to all other types of businesses that we know or that we are going to discuss, it's a very small. So access to capital is also limited. It is within the limit, is depend upon the relationship or the owner. It's totally depend upon the owners, how much, how strong the owner has relationship with the banks, with the lenders, or with the they do not have or they cannot raise money through the equity markets. Obviously they do not have so much a lot of sophisticated debt options as a source of finance, so very limited. They would rely probably on their personal savings, which will be the equity for the business, or they can go for a loan, right? That also depend on the business as well as the relationship of owners with the bank. The second type of business is the partnership. When we talk about partnership business, there is a general partnership that you guys aware of, or you guys know that the general structure of the partnership we know is. And then the more sophisticated structure of partnership, we have the limited partnership. When we talk about general partnership, and if we apply all these factors, so legally the partnership business is not separate. Again, it's just an extension, it is not separate. The partnership business is not separate. The partners, they are not separate legally from the business. Second, who operate the business, because uh, the owners and the business is not separate legally. It's not, it's the same thing, right? So it will be, or it is being operated by partners. Okay, so they have the mutual responsibility, shared responsibility for running the businesses, right? So they have the all decision making power. They are involved in routine activities, decision making activities, all that. So in short, in summarize, they run the business, right? And the third point is liability status. Remember, when we talk about partners' liabilities from the business point of view, it is again unlimited. Every partner has unlimited liability. They are, every partner is fully responsible for the debt of the businesses according to whatever the agreement they have, all the terms, all the conditions, all the profit sharing ratio, loss sharing ratio, everything will be written in the partnership agreement. It can be, the agreement can be written, agreement can be verbal, or I mean, it can be incidental. Incidental means depend upon the actions in the past regarding the partners. So in the partnership structure, again, business is not separate in the eyes of law from the partners. Partners have unlimited liability. Okay, so this is a most important point. They have unlimited liability. uh, when we talk about profit, the taxation point of view, so the profit of the business will be considered as personal income. Whatever the profit sharing ratio, whatever the salaries partners are withdrawing from the partnership business will be considered their personal income. So it will be treated as personal income. And the last point, access to capital. When I compare the general partnership business with the sole proprietorship business, so clearly the partnership business will have more access to capital because there are different partners. In sole proprietorship, only the single person is there, only the single man, single owner is there, who is responsible for all the investments, all the losses. But in the partnership business, partners are I mean, they have the mutual responsibility. They will be coming up with their monies. Every partner, let's say 5 partners. So 5 partners are investing money into the businesses. So access to capital compared to sole proprietorship business obviously is large. When we talk about limited partnership business, what is this? This is the more sophisticated form of partnership businesses, and that is very common when we talk about the firms like law firms, accounting firms, hedge funds. So this is the most common structure followed by hedge funds particularly. What is limited partnership or LLP business? This is the business in which some partners are the general partners and some partners are the limited partners. So the general partners, they are basically the managers, we can say, or the investment managers from the business point of view. Plus they are also the investors, not that level. I mean, if I do not, or if I exaggerate, 97% to 99% of the money will be coming from limited partners, and that money will not come all at once. We will discuss that, how the money will be injected from limited partners to this business. So the general partners, they have the they have the management responsibility. Obviously that is their core responsibility, plus they also investing 1% to 3% they are investing in this business. So from the liability point of view, general partners have unlimited liability. So all the debt of this limited liability partnership business, general partners are fully responsible for that. But these are the core investors, or these are only the investors. They do not have any concern, or they do not have any responsibility regarding the management or regarding the running of the businesses. So they just invest their money. And then in detail we will talk about this structure, the fees, how the fees is charged, how the money is distributed, all that with the certain limitations and certain restrictions regarding the redemptions and new investment. All that we will discuss in the alternative investment topic. So they are the core investors. Because they are the core investors, their liability is limited. That means in the event of default, in the event that business is unable to satisfy the loan, limited partners do not have liability beyond their investment. Beyond their investment means that if this business fails, if this business default, the maximum or in worst case scenario the limited partners will lose is their money. They are not responsible for any liability beyond their investment. I mean, the lenders cannot ask limited partners to satisfy the loan if businesses are unable to satisfy, because in the event of claim, the priority claim is debt holder. Then if we divide the preference and common shareholders, the second priority is preference, and then the equity holders or the common shareholders. So the point that you need to remember is the limited partners, they have limited liability in this partnership structure. Now clearly, because the general partners, they are taking more responsibility, they are responsible for they are managing routine business day-to-day activities, as well as they are investors, plus they have unlimited liability if business default, if business do not have sufficient cash flows to pay back the loans, to service the debt, then they are fully responsible, right? So we can say that general partners can demand higher share of profit compared to the limited partners, but that is just from this corporate issuer perspective. I said that they can demand or they may demand. It's not the it may not be the actual scenario. I mean, it may be different, but that what is the fee structure, how much fee will be given to the general partners, and how much money, how much return will be distributed to limited partners, like the clauses, like we will talk about the clawback structure of a fee, we will talk about the management fee, we will talk about performance fee in the alternative investment topic. So these are the points that you need to remember from this point. And when I talk about liability status, again, liability, when we talk about from the general partners liability, the business, we have discussed the liability, the legal status. Legally the business is not separate from the owners, particularly when we talk about the general partners. But when we talk about, I mean, we can say that they are separate in a sense that when we are discussing the general partner role, because they are also investors, but they're not the large investors or the major investor. But when we talk about from the perspective of limited partners, yes, the business is separate, but that depend upon the jurisdiction. That is not the point here. We are discussing that is the business legally separate, the limited liability uh, partnership. Access to capital, obviously large, significant. You can think about hedge funds. Millions and billions are invested by the limited partners, are committed by the limited partners. So access to capital is higher compared to the general partnership business, and obviously compared to the sole proprietorship business. Okay, and then we have the corporations. Corporations, as the name says, it's also we call as a limited company, right? So the liability, the name says limited company. The liability of the shareholders, liability of the owners is limited to their investment. I mean, in the worst case scenario, in the event of default or in the event of liquidation, the maximum they can lose is their investment, but they're not responsible for any debt of the businesses. If the business after liquidation do not have sufficient cash flows to satisfy the creditors payments, lenders payment, debt holders payment, then shareholders are not responsible for that. So when I interpolate these 5 points on companies, first point is legally separate. Yes, in case of companies, the business is legally separate. Then who operate the business? In case of companies, businesses are operated by managers, board of directors, and owners are separate. So owners do not operate business, obviously, in case of companies. And what is the relation between owners and runners or managers or board of directors? That is the principal agent relation when we talk about from the perspective of companies, because these board of directors, they are the agents. So the relation between shareholder, it's a principal agent relation. The board of directors, they are the agent of principal, who are the shareholders. So what is their job? Their priority of interest is shareholder. Their job is, their fiduciary duty is to act in the best interest of shareholders. So that is the second point on companies that who operate the business and what is the relation. I have discussed already the liability status is limited from the company's perspective. Tax treatment. When we talk about companies, there is a concept of double taxation. What is double taxation? Double taxation is, first of all, the tax is levied, tax is applied at a corporate level, which is earning before tax. So, for example, in this scenario, we have $10 million earning before tax, and assume that the 100% payout, doesn't matter whatever the payout ratio is, but right now the concept we are talking about is the double taxation. So first of all, the tax is levied at company level. So this $10 million is taxed at 25%. So $2.5 million deposited or transferred to the government, right? So now only the $7.5 million is available for distribution. Now, assuming that the company distribute all money, 100% payout, now on this already taxed profit, already taxed money, the shareholders will pay 20% in their individual capacity. So when we talk about from the shareholder or from the company perspective, from the corporation perspective, although 25% is being paid by companies and the 20% on dividend is being paid by the shareholders individually, but think in the absence, who is bearing this 25% impact? Ultimately the impact is borne by shareholders, because assuming in the absence of any company, any companies or corporate income tax, which is obviously will not be a scenario until unless the certain types of businesses are exempt from taxation. So we have in this scenario, we will have, in the absence of 25%, we will have $10 million available for distribution, and then in case of any absence of this 25%, the whole $10 million will be taxed at 20%. So that means that the tax is being levied at two levels, or the governments are applying the taxes on already taxed profit, on already taxed income or taxed money. So technically, or companies, or in total from this business perspective, the tax has been paid is 2.5 million at company level, plus 1.5 million was paid by shareholders in their individual capacity. So in total we have paid $4 million against a $10 million profit. So in total effectively we paid 40% tax from this business perspective, right? So this is the concept of double taxation. Now from the exam point of view, examiner can give you absolute numbers and may require you to calculate the effective tax rate. But if absolute information, absolute numbers are not given in this format and only the percentages are given, then how you can calculate the tax? Then the formula that you will use for corporate tax is effective tax rate formula is corporate tax rate plus individual tax rate into 1 minus corporate rate. So like in this scenario, we have 25% corporate tax, individual tax is 20% into 1 minus corporate tax, which is 25%. So 75% of 20 into 0.75 is 15, and 25% is a corporate tax. So look, we got the same answer. Effective tax rate is 40%. So remember this formula. All right. So this is how you will calculate the effective tax rate in the exam, and this is the perspective and meaning and concept of double taxation. And then we divide the companies into two. We have the private limited companies and we have the public limited companies. Obviously, the public limited companies are those which are listed on stock exchange, whose shares are traded on stock exchange and whose shares are issued to general public. Everyone in the public can buy and sell those shares. When we talk about companies perspective, obviously as in business structure, they have the greatest access to capital in compared to all other businesses structure like sole traders, sole proprietorship, partnership, limited liability partnership. So we divide the capital into two categories. One, we have the borrowed capital, which is in the form of debt. It is a liability of the business, but it is the capital, like they issue the bonds, they take a loans, a lot of different sources that we will be talking about as we move on. And we have the ownership capital, which is basically the equity, the money invested by owners, by shareholders. Okay, this is just the legal point. I mean, we don't have much discussion here. We have discussed at a start that companies they have the legally separate, or they have the separate legal status. They are the separate legal entity from the eyes of law. So at the time of formation, they submit articles of incorporation where the rights and responsibilities are written, right to hire employees, contracts, borrow, lending, everything relating these are written in the articles of incorporation. And shareholders, because they are the owners of the businesses, they have invested their money in the businesses, right, either in the form of founders or larger controlling shareholders, or in the form of government, or in the form of minority shareholders. They have the voting rights and they use their voting rights in the annual general meeting or extraordinary general meeting, which is the EGM, regarding different matters like election of board of directors, regarding decision of merger and acquisition, takeover, things like that. What sort of or whatever matters require the decisions, shareholders cast vote. They use their voting right. Okay, so let's compare the private and public listed entities. So first of all, the companies which are listed, they are listed on obviously the stock exchange. Because they are listed on the stock exchange, they have to follow the exchange rules and regulations. They are public listed entities, so they have the public accountability, public scrutiny. They have the larger reputational impact. So because of these factors, and particularly because of the exchange, we have the price and volume transparency. Every minute, every second, the prices and volumes are being updated. Shareholders can be individuals, can be the companies. I mean, one company can invest in the equity of other companies, which is called intercorporate investments, or the shareholders can be governments. Okay, then we divide the shares, we divide the outstanding shares or total capital, outstanding shares of companies total, and then we subtract the shares held by governments, founders, families, governments, which are the strategic investment by the governments, like petroleum companies, right? So the difference, we remove these shares from the outstanding shares. That is called free float. The shares, these are the shares which are actively traded in the market. So whenever you have to buy the shares or sell the shares, that is from the free float. We cannot buy or sell those shares which are held by founders, families and friends, and governments, etc. So only the shares that we can buy or sell is the free float. Public companies, they have the greater compliance and reporting requirement, like they have to file their financial statements quarterly or annually, right? They have to file these statements. They have to comply strict laws, regulations. If there is any material changes, they have to report. I mean, they have the greater scrutiny. They have the significant, substantial compliance and reporting requirements. But when we talk about private companies not traded on stock exchange, because they are not traded on stock exchange, so their value is not readily observable. So I mean, if I have to purchase Apple shares, whatever the share price is, I will purchase. I know the share price of Apple because it is published. But when we talk about private companies, because infrequent trading, because of illiquid investments, the value is not readily observable. Rather, we have to use the complex financial models, or we have to use valuation techniques for valuing the private companies. And most of the time, the price is negotiated between the investors and the private companies. From the regulatory point of view, there are few requirements. Less, they disclose less information when we talk about, when we compare it with the general public. And obviously, when we talk about the number of investors, volume of investors, public companies have a lot of investors, a number of investors. But when we talk about private companies, they have the fewer large investors. And remember this point, the view is longer in nature, long term. You do not come and invest in private companies for a very shorter tenure. As I said, as I use the word illiquid, we will discuss this private equities, private capital, private debt, private companies in in alternative investment topic. Okay. Uh, the question is, who can invest in the private companies? That is called accredited or qualified investors. These are the corporates, these are the institutional investors, or these are the high net worth individuals who have sufficient substantial amount of wealth as well as investment experience, knowledge, all that. These are the accredited investors. Okay. And obviously the capital is raised through private placements. It's not the public investments, it's not an IPO. It's a privately invested by different kinds of investors like we just discussed. Okay. Now a private company wants to become public. What are the ways? First way is IPO, initial public offer. When initial public offer means when the new shares are being offered. It's a contract, it's an, you can say, offer to purchase. When the new shares are being offered by the company, by the shareholders to the general public first time. Okay, and that is through the stock exchange. Companies will be listed on the stock exchange and new shares will be issued to the general public for the very first time. The private companies, they do not have any public company experience, so they will hire the investment bank play or involve in this transaction in two ways. Either they play an underwriter role or they go for best effort selling. In the underwriter category or in the underwriter type, investment bank purchases all the shares that are offered by the public. They purchase all those shares and then they sell themselves at whatever the price they want, right? So they purchase themselves. But when we talk about best effort selling, and the best effort, investment bank purchases, they do not purchase the shares from the company, rather they act as an agent. They will say, okay, we'll try our best to make sure that your shares or your IPO is fully subscribed, but in case of any unsold shares, we are not responsible. But in case of underwriter, as I said, they purchases all the shares, so unsold shares are responsibility or they are being held by investment bank itself. Okay. So what is the benefit of an IPO to the company? Because I said I use a word new issue, so we raise the money. It's just a new shares. Okay. But the problem of this method is time consuming. As I said, investment bank is involved. Okay, it's a first time your shares are being issued, so involves road shows. It's heavy marketing, letting know the public who you are, all the financial perspective of the companies, because it's the first time the companies are being listed and first time the shares are being offered, and the public have no idea who you are, who the company is, what are the investment prospects, everything. Okay, so it's take time of an IPO. And because the investment bank is involved, so it's a costly. The benefit is new money is raised. Okay. Another way is direct listing. Direct listing is when the company says that we have this number of existing shares, just list those shares as an public listed. Okay, so in this structure, direct listing, the shareholders, they are offering their existing shares to the general public for the very first time. Yes, they are offering their shares for the very first time, but this is not IPO, because in IPO the company offers to issue offers to offer the public to purchase new shares. In the direct listing, remember, no new shares are involved. Okay, so in this direct listing, companies do not raise any capital. Okay, so from the perspective of method, because we are discussing the ways through which public private company can become a public company. This is a quick method when we compare with the IPO. This is a less costly. Why? Because investment bank is not involved, no road shows, no sort of those things are being carried out. So what is happening is just the whatever the existing number of shares are being listed, right? So remember this point: no underwriter, no. It's a very quick. No new shares are issued. We do not issue any new shares. No new shares are issued. Okay. Another way is SPAC, Special Purpose Acquisition Company, that we will discuss in detail in the alternative investments. It is basically when sponsors or the private company or the private equity fund, they wanted to purchase an unidentified private company. Okay, so what they do is they set up an SPAC, Special Purpose Acquisition Company. Okay, so they will, the founders, the sponsors, or the larger group of investors, they will create an SPAC. The SPAC will go through an IPO, and the money raised from IPO will be put into the trust. The purpose of this, sole purpose of this money is purchase the company. Okay, purchase any private limited company within the time frame. Okay, any private company. And what if you are not, or SPAC is unable to purchase any private company within a time frame? Let's say the time frame is 12 to 24 months, then you have to return this money to the investor and delist the SPAC from stock exchange. And what if the SPAC is able to acquire, or the sponsors are able to acquire the any private company within this time frame? Then this SPAC, this private company will flip with SPAC, will merge with SPAC, and SPAC will be delisted from stock exchange. And now the newly acquired private company will become the public listed entity. I mean, it's just flipped exchange with SPAC. As I said, it's being merged, right? So this is the whole purpose of SPAC. So what the points, key points that you need to remember is the SPAC raises money through an IPO. As I said, goes through as an IPO, put the money into trust, and the purpose is acquisition of any private company. Which private company do they mention? They do not. That's why we call the SPAC as blank check. Okay, at the time of SPAC IPO acquisition, the company will be unidentified. So these are the ways that you need to remember of becoming a private company to the public listed entity. Then there is another way through which a public company can become a private company. Why a public company will want to become a private company? Probably if the public company continue in the business as the public company, the loss from continuing is higher as a public listed entity. The public is, the company is a loss making, so they think that it's better that we operate or we remain in the market but as a private listed entity, because in that listing requirement, compliance requirement, regulatory requirement, public scrutiny, all that will be gone or will be very lower, right? So that is that is a reason a listed company want to become a private company. Now, what way do we use is the way that we use to become to convert a public listed into a private is an LBO. The method that we use is leverage buyout. Okay, so what they do is a group of shareholders, large number of shareholders, we can say, or a group of strong shareholders, they borrow the money, leverage, they borrow the money and purchases all the shares of an public listed entity, and then they delist it from the stock exchange. This is the LBO, leverage. So they borrow the money, then they convert the public listed entity into the private company, and then whatever the cash flows, because I said now the public listed entity will be operating in the market as private listed entity, but they are in the business, they are in the market, they are being operating as a private, right? So whatever the cash flows will be generated by private companies will be used to satisfy the loan that was initially taken to purchase to acquire this public listed entity. That is the procedure of LBO. The more detailed procedures and types of leverage buyout we will discuss in the alternative investments. So look at some sort of questions how the, I mean just few. Uh, so which organizational form has the highest degree of separation? Obviously the corporations. They are talking about the legal status. And when we talk about limited partnerships, the owners and businesses are not separate. General partnerships are obviously not separate. In limited partnerships, we can say the owners are separate, the managers are separate, but again in the limited partnership, one type of partners, which is the general partners, they are not separate. They also invest their money. When you talk about, look, I told you earlier that in case of double taxation, examiner will ask you calculate the effective tax rate. So this is we will apply the same formula, corporate tax rate, which is 10% plus individual tax rate, which is 15%, into 1 minus corporate tax rate, which is 10%. So we calculate 15 into 90%, then 10%, you will get 23.5%. A private company can become a public through private placement. No, this kind of way we haven't studied. This is not the way, because private placement is how we can invest the money in the private companies. Okay, leverage buyout is an opposite to this. Leverage buyout is we use this strategy to convert a public listed into a private. But here we are talking about that how a private can become. We discuss this back. Okay. So this is all about this trading. We'll discuss the next in the next class. Take care of yourself and see you in the next class, in the next session. Take care. Bye bye.